Hi everyone and welcome to our Made for YouTube series. I'm Sumaira Abidi. Now today I want to actually talk about a new set of rules which have been introduced by SEBI. SEBI is the market regulator. So late last evening they came out with a rule which is called swing pricing for open-ended debt mutual funds. Now what is swing pricing? I think it's pretty suggestive by the name, but let me explain. So actually what had happened in the fallout of the Franklin case was that a lot of very savvy, a lot of institutional investors had made huge redemptions, from the 6 shutdown Franklin schemes, and I mean to the tune of maybe 1,400, 2,000 crores a day. Now, no mutual fund scheme is geared up to honor those kind of redemptions day after day after day. So normally, how are redemptions honored is that each scheme will have some cash on their books, so they will pay from that because the next day again SIPs will come in. Otherwise, what you can do is that SEBI allows you to borrow up to 20% plus scheme from the market. So you can borrow from a bank up to 20% of the AUM. So if you feel there are normal redemptions, you will just borrow from the bank. You will pay the outgoing investors, and the next day when SIPs come in, you pay back the borrowings. The last scenario is that you start selling papers which you have, the bonds which you have in your portfolio is the last port of call, right? Because you don't want, just to pay a little bit amount to some redeeming investors. You don't want to let go of your bond because it will disrupt your portfolio. But if it must be done, it must be done. Now in Franklin's case, what happened was that because it was a pandemic, they couldn't, even if they wanted, they couldn't sell the papers. They had already maxed out a lot of their savings. And so it led to a situation where, among other factors, it led to a situation where the schemes were shut down. So the ones who had redeemed, they received the full NAV of the day on which they redeemed. But the long-term investors, the retail investors who had stayed back in this scheme, who perhaps didn't know that there could be trouble ahead, now they were left, holding the baby. So since then, in fact, it was my news break on the 14th of July last year that SEBI was considering swing pricing. Now, globally also swing pricing is undertaken in extreme situations. So over a year, SEBI has deliberated and sought opinion from various stakeholders and expert committees, and now finally they have said that for very high risk open-ended debt funds, they will allow swing pricing. Now, what is swing pricing? So basically, if there is an investor who wishes to redeem, and the amount that they have specified is redeem over 2 lakhs. So if I wish to redeem from a scheme and there is an adverse impact on the scheme because of my redemption request, then the mutual fund house, the asset management company, they can adjust the NAV of that scheme for me so that the long-term investors who are left back in the scheme are not adversely affected because I am choosing to withdraw. Right? So this is basically to protect the interests of those investors who stay back. So this will swing according to the amount of redemption, the market condition. So AMFI is going to come up. AMFI, which is the Association of Mutual Funds of India, has been tasked with creating the trigger mechanism. At what price or under what conditions will this swing pricing be triggered? So for normal day-to-day business, SEBI says that it can, you can undertake partial swing. But in times of market dislocation, mandatory full swing will be imposed on the schemes. And there's a certain category of schemes which are high risk or very high risk. Now, what is market dislocation? Market dislocation just means a situation, an adverse situation, when the market is not able to price assets correctly, right? So it could be some globally a news which impacts all markets globally. It could be our own market, some new announcement has come and there's a massive correction, etc. Or a situation where the bond market is in a tizzy. So basically that definition of exactly what is market dislocation, how much movement in price will constitute market dislocation. So SEBI will give the exact definition of that market dislocation soon. And once those conditions are met, so SEBI will give the fund houses the go ahead and say, market dislocation conditions have been met, please implement mandatory full swing. So what is the difference between partial swing and mandatory full swing? All of those are conditions which AMFI will come out with. That this is the trigger limit for partial swing, this is the trigger limit for full swing, and therefore how much will be the range in which the NAV can move, etc. So we're awaiting all of those details, and in any case these rules are not to be implemented straight away, right? So from the 1st of March next year is when these rules will come into play. But to my mind, this is a very, very good set of rules, because under no conditions should those investors who have chosen to stay invested for the long term be impacted because of some institutional trends or the decision by some of the larger investors. So I hope you enjoyed this, and I'm sure there are many questions regarding swing prices, and in the days to come, as and when more details are available, we will make another video on it soon. So for the moment, thank you very much for watching. Your comments and suggestions, as always, are welcome. Stay safe.